Stocks closing higher to start the week. It's been an interesting few months for the bond market with investors navigating political uncertainty. Yields also moving higher today, but the 10-year is down to 4.2% off of the 2024 high of 4.7% back in April. For more on the latest market action, we're bringing in Michael Kushma, Senior Portfolio Manager at Morgan Stanley Investment Management. Michael, it's good to see you. So listen, today obviously politics are front and center, Michael. We had a lot of uncertainty already with this election. Now we have more with President Biden withdrawing and endorsing Kamala Harris. I'm just curious, Michael, what kind of questions, if at all, are you getting from your clients just about all this, and what are you telling them?
Well, the real big question is all about if there's a Republican administration, how will that change economic policy, and what will that mean for economies, for asset prices, things like that? Because the Republican platform seems to be quite different than what we're used to the last 4 years, and we're probably going to get some version of the previous Republican administration in terms of policy agenda. So if we are talking about increased tariffs, tax cuts in other areas, and what that means, for the economy, I think that's still the number one question.
And Michael, does it make sense? It has seemed that when the odds, sort of the betting markets, put a higher probability on former President Trump winning, that we see yields come down a little bit, and then the converse being true. So does that make sense to you at this point, or do you think the market is sort of trading on incomplete information?
I think it's very incomplete information. We really don't know how the election is going to turn out. There's a lot of questions between now and then which have to be answered, not just on who wins the election, but in terms of how the Fed runs monetary policy between now and then. The market's quite confident that we'll get 2 rate cuts this year, maybe a smaller chance that we get 3 between now and year end. The fluctuations and the probability of that structure of forecasts, I think, for now, is more powerful than guessing as to what may happen at the election.
Does it make sense to you, Michael, that we would see a cut from the Fed this year?
It does. Growth has decelerated. Final demand in the U.S. economy was growing well over 3% in the second half of last year. That's downshift to a more normal 2% plus kind of trajectory. Inflation, after a big hiccup and a scare in Q1, has resumed its downward trajectory. So I think what the Fed can say is that we don't need an easy monetary policy, but we do need a less restrictive monetary policy because the economy is coming into more balance. Inflation is closer to target. The unemployment rate has been going up. We can afford to have a few rate cuts and keep policy restrictive, but not as restrictive. So I think that's easy to do going forward, as long as we don't get any really negative surprises on inflation in the next 2 months.
And what do you think all of this means for the yield curve, which of course remains inverted, even though it has been widening a little bit here? But how do we look at that as both as an indicator and as something that you're trading?
It's the indicator has not been working, right? It's been inverted for a longer period of time than ever in history. It's normally a precursor of economic weakness. It really hasn't shown up. I think there are good reasons for that. So it's not been a good indicator showing what's going to happen in the economy going forward. And I think the reason why that it's been inverted is a couple of things. One, inflation's coming down, which keeps long-term interest rates attractive. Secondly, the level of long-term interest rates is very attractive by historical standards. We average 2.5% 10-year yields prior to the pandemic, post-global financial crisis. Now we've got 4.5% 10-year interest rates. Yet at the same time, the Fed's keeping a restrictive monetary policy, which keeps short rates high and inflation expectations low. I think as the Fed starts normalizing interest rate strategy and interest rates start coming down, the curve will become less inverted. Whether or not it goes positively sloped, I think, is a bigger question when that happens, because we'll need substantial rate cuts, I think, to get it positively sloped. That probably is not in store for us until the end of Q1 next year.
So, Michael, add it up to us. If you're a fixed income investor, you're listening right now. What's your advice, Michael?
The advice is don't worry. We are in this sweet spot of the economic performance, sweet spot of monetary policy, in the sense that the Fed is on the verge of beginning to bring down interest rates. How far and how fast remains to be seen, but that's the right trajectory. Economic growth has softened, but it's not weak. There's a big difference between the two. So that means credit conditions should be okay. Bank lending standards are easing at the margin. We're getting decent economic performance, decent earnings. This is all supportive of credit, whether it's high yield investment grade. It's good for the rest of the world in terms of lower interest rates in the US. So it's all pretty good. However, don't expect some big bull market at these valuation levels, but it should be solid performance for the remainder of this year.